preparing for a Mubadala Investment Company interview questions interview. You've reached Candy Mentor, and this video is for you. We'll walk through 15 key questions you're likely to face. For each question, you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work at Mubadala Investment Company? I would frame Mubadala as a rare platform because it combines institutional investment discipline with a national development mandate. The appeal for me is working with long-term capital across sectors like technology, energy, healthcare, infrastructure, and financial services. That forces deeper thinking than just near-term earnings. I'm also attracted to Mubadala's partnership model, where value creation often comes through strategic relationships, operating expertise, and patient capital, rather than purely financial engineering. While answering, focus on Mubadala's sovereign wealth mandate, global platform, long-term capital, sector breadth, Abu Dhabi development role, and why those factors match your investment interests and career goals. Question 2. How would you describe Mubadala's investment strategy? Mubadala's strategy is to deploy long-term capital into global sectors where it can generate attractive risk-adjusted returns and support Abu Dhabi's economic diversification. It is not only buying passive exposure. It often builds platforms, partners with leading managers, and invests across the capital structure. I describe the approach as thematic and partnership-driven, with emphasis on sectors where structural growth, technology, energy transition, or healthcare demand can compound over many years. Make sure to cover long-term value creation, global diversification, thematic investing, partnerships, direct investments, fund commitments, and the balance between financial returns and strategic contribution to Abu Dhabi. Question 3. What makes a sovereign wealth fund different from a private equity fund? The biggest difference is the capital base and time horizon. A private equity fund usually has third-party LP commitments, a defined fund life, and pressure to exit within a certain period. A sovereign wealth fund invests national capital, often with a much longer horizon and broader objectives. That can allow more flexibility on holding periods, sector exposure, and partnerships. Still, the discipline is similar. Every investment must be underwritten on risk, return, governance, and value creation. In your answer, compare capital source, time horizon, liquidity pressure, return objectives, governance, public responsibility, and ability to hold assets longer than traditional closed-end private equity funds. Question 4. Walk me through how you would evaluate a potential direct investment for Mubadala. I'd start with the investment thesis. Why this company, why now, and why Mubadala is the right owner or partner. Then I'd assess the market, competitive advantage, management team, revenue quality, margins, cash conversion, and capital needs. I'd build valuation using comparable companies, precedent transactions, and DCF analysis. Finally, I'd test downside cases, governance rights, exit routes, ESG issues, and strategic relevance before forming a clear investment committee recommendation. Be sure to mention market attractiveness, competitive positioning, management quality, financial model, valuation, downside risk, exit optionality, ESG considerations, strategic fit, and investment committee recommendation. Question 5. If Mubadala is considering an investment in a growing healthcare company, what would you analyze first? In healthcare, I'd first understand the source of demand and whether growth is structural or temporary. For example, is the company benefiting from aging populations, better access to care, or a differentiated treatment model? Then I'd look at reimbursement exposure, regulation, clinical outcomes, patient retention, and scalability. Financially, I'd focus on revenue visibility, margin expansion, and cash needs. The key is separating a high-growth story from a durable healthcare platform. While answering, focus on healthcare demand drivers, reimbursement risk, regulation, clinical differentiation, scalability, unit economics, management credibility, valuation discipline, and Mubadala's long-term thematic fit. Question 6. How would you value a company with strong growth but negative free cash flow? For a high-growth, cash-burning company, I would not rely on current EBITDA or free cash flow alone. I'd focus on unit economics, gross margin trajectory, customer acquisition cost, retention, and the timing of operating leverage. Valuation would use forward revenue multiples, peer benchmarks, and a DCF with explicit assumptions on profitability and reinvestment. I'd also model funding needs carefully because dilution or additional capital can materially change the real return. Make sure to cover revenue quality, path to profitability, unit economics, cash burn, funding needs, scenario analysis, comparable multiples, DCF limitations, and how to avoid overpaying for growth. Question 7. Tell me about an investment theme you think would be relevant to Mubadala. One theme I'd highlight is AI infrastructure, especially data centers, power availability, cooling technology, and semiconductor supply chains. The demand is being driven by cloud workloads, enterprise AI adoption, and national digital strategies. For Mubadala, this theme is relevant because it connects technology, infrastructure, energy, and long-term strategic partnerships. I would be careful on valuation, though, because not every AI-linked asset deserves a premium. Power access and contracted demand matter. In your answer, choose a theme tied to Mubadala's interests, such as AI infrastructure, energy transition, healthcare innovation, logistics, semiconductors, or private credit, and support it with clear drivers. Question 8. How do you think about risk when investing long-term capital? Long-term capital reduces liquidity pressure, but it does not eliminate risk. I would define risk mainly as permanent impairment of capital, not short-term volatility. That means focusing on balance sheet strength, industry disruption, governance, currency exposure, regulatory shifts, and entry valuation. I'd also ask what must go right for the investment to work. If the base case depends on perfect execution, multiple expansion, and cheap refinancing, the downside risk is probably understated. Be sure to mention permanent capital loss, valuation risk, leverage, governance, currency exposure, political risk, liquidity, concentration, downside scenarios, and how long-term investors should still remain disciplined. Question 9. What would you include in an investment committee memo for Mubadala? An investment committee memo should make the decision easy to debate. I'd include the executive summary, transaction structure, investment thesis, market overview, company performance, valuation, projected returns, key diligence findings, risks, mitigants, governance rights, and exit routes. For Mubadala, I'd also address strategic relevance and partnership benefits. The memo should not hide weaknesses. It should show whether the expected return compensates for them under realistic assumptions. While answering, focus on concise thesis, transaction overview, market analysis, valuation, financial projections, risk factors, strategic rationale, ESG review, governance terms, exit options, and clear recommendation. Question 10. How would higher interest rates affect Mubadala's investment decisions? Higher rates affect both valuation and capital structure. Discount rates rise, leverage becomes more expensive, and exit multiples may compress, especially for long-duration growth assets. At the same time, higher rates can create opportunities in private credit, infrastructure, and stressed sellers needing capital. For Mubadala, the advantage is patience. It can be selective, demand better pricing, and invest where fundamentals remain strong, but market conditions have reset valuations. Make sure to discuss discount rates, valuation multiples, financing costs, leverage capacity, private market exits, infrastructure returns, credit opportunities, and how patient capital can benefit from market dislocation. Question 11. How would you assess whether Mubadala should invest directly or through a fund manager? I'd compare the importance of control and expertise. Direct investing can offer better economics, governance influence, and deeper strategic value, but it requires sourcing, diligence, monitoring, and operating capability. Fund investing provides diversification, access to specialized managers, and local expertise, especially in complex geographies or niche strategies. The best model may be hybrid. Commit to a strong manager, earn co-investment rights, and build internal knowledge for future direct deals. In your answer, compare internal expertise, deal access, control, diversification, fees, co-investment rights, speed, sector complexity, geographic knowledge, and when external managers add genuine value. Question 12. Give an example of how you would build a downside case for an investment. Suppose the base case assumes 12% revenue growth, margin expansion from 18% to 24%, and an exit at 10 times EBITDA. My downside case might use 6% growth, flat margins, higher working capital needs, and an exit at 8 times. I'd also test refinancing costs and delayed exit timing. The point is not to be pessimistic for its own sake. It is to see whether capital is protected if the thesis only partially works. Be sure to cover lower revenue growth, margin pressure, delayed exits, multiple compression, higher financing costs, working capital stress, covenant risk, and whether the investment still protects capital. Question 13. How do ESG and sustainability considerations affect investment analysis at a firm like Mubadala? For a long-term investor, ESG is not a box-ticking exercise. It affects risk, cost of capital, reputation, and exit value. In energy, I'd examine emissions intensity and transition plans. In healthcare, I'd look at access, quality, and patient outcomes. Governance matters across every sector because weak controls can destroy value quickly. Good ESG analysis helps identify hidden liabilities and also opportunities, especially in energy transition and sustainable infrastructure. While answering, focus on ESG as risk management and value creation, climate exposure, governance quality, social license, reporting standards, sector-specific issues, and alignment with long-term institutional capital. Question 14. What is one recent market development that could create opportunities for Mubadala? A relevant development is the global reshoring and regionalization of supply chains, especially in semiconductors, pharmaceuticals, and critical infrastructure. Governments and companies want more resilient supply, even if it costs more. That creates opportunities in manufacturing platforms, logistics, industrial real estate, and enabling technologies. The risk is paying too much for policy-driven growth. Mubadala could benefit by partnering with operators where capital, relationships, and long-term patience are real advantages. Make sure to choose a current macro or sector trend, explain why it matters, identify investable angles, discuss risks, and connect it to Mubadala's long-term and global investment approach. Question 15. What questions would you ask us at the end of a Mubadala interview? I would ask questions that show I understand the platform. 4. In your answer, show curiosity about investment process, team structure, sector priorities, portfolio monitoring, cross-border collaboration, culture, training, and how junior professionals contribute to real decisions. If you are still with us, congratulations. You are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.